The 60/40 portfolio has been a widely recommended investing strategy for decades. Recently though, a lot of people have been asking if it's dead, which shows a crucial misunderstanding of the way the strategy works. Today, we'll see what the 60/40 is, what was it created for, what its key problems are, and finally, whether I think it's an appropriate strategy or not. The 60/40 portfolio was created as a way to balance out the volatility of the stock market, which gives you way better returns in the long run, but can go down quite drastically in times of turmoil. In order to avoid a big drawdown of the whole portfolio, bonds were introduced to balance out these stock market downturns. Why? Well, because usually when stocks go down, bond prices go up. The reason for that is pretty simple. When investors feel frightened and are not sure how the economy and companies are going to perform, they flee to an asset which is safer. Why safer? Because it has fixed payments, unlike the volatile stock earnings, and is guaranteed by the government in the case of government bonds, or is of higher priority for the companies in the order of which they pay to investors in case of corporate bonds. When that happens, the prices of those bonds rise because when more people want them due to the laws of supply and demand, they become more valuable. When a portfolio is structured in such a way, when investors are optimistic and the economy is doing fine, they will buy more stocks, making the value of the stock portfolio part rise. When they turn pessimistic and there is trouble on the horizon, they will bid up the prices of bonds, making the bond part of the portfolio go up in price or at least not go down as much. We can see this has been the case in times like the financial crisis of 2008, when even though the stocks crashed 37%, the bond part of the portfolio was up 5%. An even better example is the dot-com crash in 2000, when the US stock market went down 10.5% and the bonds went up 11.4%, neutralizing the losses from the stocks. Simple and easy, right? Well, as a lot of things, it was, until it wasn't. Then 2022 happened, and for the first time in decades, both bonds and stocks went down with double-digit percentages. That came as a shock to investors, but it wasn't because some anomaly happened. This was totally predictable, and I'll explain to you why. The reason was that in the developed world in 2022, inflation spiked significantly for the first time in 40 years. You see, inflation is a bond killer. The reasons are two. First, when you have an asset that has fixed payments, these payments become less valuable when inflation goes up. It's normal to not want to receive 2% on your money when inflation is 5%, right? And the second reason is that when inflation is high, central banks like the Fed in the USA, ECB in the EU, etc., increase their interest rates to fight inflation. This is also a bond killer because when interest rates rise, the prices of the already existing bonds, like the ones you have in your portfolio, fall. At the same time, because of the rising interest rates, recession expectations, and the lowering of the money supply, stocks go down as well. This creates a nightmare scenario for the 60/40 portfolio where stocks and bonds become correlated, meaning they move in the same direction instead of balancing each other out. And here is where people were caught off guard. Because it has been working well for decades, a lot of investors never stopped to actually ask themselves what was going on beneath the hood. For those people who are familiar with my videos, you know this is one of the things I emphasize the most. Whatever you own, never ever own it without understanding it, even if it has been working well for decades and everyone tells you to do it, because it only takes once for something to go wrong. And when it does, you will be staring at the screen, having no idea what's going on. The 60/40 is a great example of that. Here is why. The reasons it worked so well in the previous decades were two. The first one was the unipolar world, which led to globalization. The USA was the dominant power and no one dared to do anything without their consent. This ensured the world can globalize, especially after the end of the Cold War, which meant there were less wars and easier trade for everyone. That meant that there were reduced instances of interruptions to the global supply chain, conflicts, and in general reduced volatility. This leads to the second reason the 60/40 worked so well. Lower and lower inflation meant rising bond prices and central banks that did not have to react to rising inflation. At the same time, businesses love predictable, stable environments, and so many corporations expanded their markets and profits, creating a boom for stock prices as well. And in the rare cases when there were shocks to the system, they were of financial nature, like the dot-com crash when internet stocks got overvalued, or banks going bust in the 2008 crisis. In situations like this, the bonds could keep their value and absorb the shock in the portfolio. However, in recent years, all of that has changed. During the pandemic, the supply chains got severely disrupted, and this was combined with the biggest money printing in history, which caused inflation to go up. At the same time, literally at the beginning of 2022, Russia invaded Ukraine, which by many historians in the future will probably be seen as the end of the unipolar world. That doesn't mean the USA isn't the strongest power, or that it soon won't be, like a lot of people are talking, because I think it is and will remain so. It just means that it isn't the sole, undisputed big kid in the schoolyard, and countries are no longer afraid to pursue their own interests, even if that means getting on the wrong side of the United States. As a result, that also triggered shocks across markets. Those factors combined led to high inflation, which led to central banks raising rates, which led to the bloodbath in the 60/40 portfolio. This shows clearly why you should not simply accept historical data or correlations without understanding where they come from, because they all work until they don't. When the dollar is strong, usually gold is weak and the reverse. Well, that works until it doesn't, like now. When inflation is up, Bitcoin is up too, because it is an inflation hedge. Well, that misses the fact that Bitcoin reacts to money printing, not the price of oil or bread. And so people have all of these mental frameworks and historical correlations in their heads, which, if not properly understood, can lead to huge surprises. The only reason these correlations work is because of all the circumstances in the particular historical period that led to them. When these circumstances are no longer there, the correlations break down. So what does that mean for the future of the 60/40 portfolio? Well, let me get my crystal ball. While neither me or anyone else can tell you what the portfolio will do in the future, I can tell you my overall opinion of it and why I personally don't like it. First, for young people. To me, it makes no sense to have such a huge allocation to bonds when they are always underperforming stocks in the long term, and because of the printing of money, their fixed principal and coupons are constantly being devalued. When you do that for 3, 4, 5 decades, you are killing your portfolio. For the older folks, I think while the 60/40 portfolio can bring certain stability if you rely on withdrawing money from your assets to live off, it also has a lot of risks. First, as we saw, if there is a spike of inflation or geopolitical shocks, the correlation stops working and both stocks and bonds go down. Do you know what the future will hold? Probably not. And second, it's funny to me how everyone thinks that once you are retired, the growth is no longer needed as much. With the improvement in medical technology, it is completely normal, if you are 60 years old, to live up to 100 in my opinion. And if throughout that time you have almost half of your portfolio in bonds, these are decades and decades in which central banks and governments will keep destroying the value of your assets, diminishing your purchasing power exactly in the years when you will need it the most. In my opinion, the best way to invest is in quality businesses which make money by providing society with valuable products and services, and also funds full of such businesses. That way, regardless of the economic conditions, whether there is inflation or deflation or geopolitical events, your portfolio should provide you with stable and growing cash flow that can pay for your life. Because of that, I have a free investing masterclass which shows you how to do it and why I think that's the best investing strategy regardless of your age, for which you can sign up by clicking the link in the description. I think this strategy works for both older and younger people, whether they are retired or not, and it will keep working in the future. Unless, of course, we get into nuclear war and the stock market disappears, but then I don't think your bonds will be able to save you either. Alright, if you like this video, press the like button and subscribe, and also check out this video that should have appeared on your screen to continue with your investing education. Thank you for watching, and please remember that all of the opinions expressed here are my own and you should not take them as financial advice.